Welcome to DevTech Finance. In this video, we will be learning about infrastructure financing. This video is a part of credit management tutorial, so I recommend you to watch all other related videos in the playlist to get a better understanding on this module. Now let's start with the introduction to infrastructure. Infrastructure refers to the physical structure and facilities needed for development of an area and operation of economy and society. So infrastructure presents a very basic framework needed to facilitate all the movements and development of any country's economy as well as the society. So it becomes important to invest in infrastructure, and thus we will be talking about infrastructure financing because it involves huge cost to build up the infrastructure. Major projects covered under definition of infrastructure are roads, bridges, highways, ports, railways, airports, sanitation, sewerage system, industrial park, broadband network, telecommunication network, and internet setup. So these are some of the examples of the projects which we cover under definition when we talk about infrastructure building. And because these projects are related to development of any particular country, it would require huge financing to be done. In earlier days, development of infrastructure was considered to be responsibility of government and there was no role of private sector involvement. So in earlier days, mostly it was in the hand of government only to build up the infrastructure and collect taxes from the public. But sooner, the private sector came into picture and there was a collaboration between the government and the private sector to develop the infrastructure. And this was due to some of the drawbacks like limited capital, so government was unable to accumulate so much of capital to develop any particular infrastructure and to cover all those areas which we talked about. And then there was slow development as well, and the quality of service was also compromised. Now, due to these all drawbacks, the private companies were also engaged in this sector. This led to existence of public-private partnership model, which we hear very frequently. This is in simpler terms called as PPP model, which involves contractual partnership between government and private sector companies to operate infrastructure projects. And this is due to this model how the private companies and the government together they came into contractual partnership to build up the infrastructure projects, to operate the infrastructure projects and to make it more reliable for the public to use. Availability of adequate infrastructure facilities is a necessity for overall economic development of a country. So as I already mentioned, it is required for all the economic activities, for the movements of public, and thus a good infrastructure also shows the development of any particular country. Now let's talk something about infrastructure financing. So with growing prominence of infrastructure in economic development, as the private players, they together collaborated with government sector, and then many big corporates like Tata's, Birla's and Ambani's, they also invested their capital in setting up of many infrastructure development companies. And due to this growing prominence in infrastructure, this compared to other sectors, the demand for bank loan from this infrastructure projects was huge. So this sector, this particular area which we're talking about, infrastructure, the demand suddenly increased and the financing was required was quite high because it was necessitated to build the infrastructure, and as our country was developing, there was a huge scope, a huge demand. And because of this, the bank loan for infrastructure projects become very relevant, and the banks started providing finance to serve these infrastructure projects. And one thing more, that the finance requirement was quite huge. So before that, banks were serving to other sectors as well as the retail investors. However, the loan requirement was not up to that level. However, now when we talk about infrastructure projects, the requirement of finance, the requirement of loan amount was quite huge as compared to other sector. And this came as an opportunities for banks to encash big projects. So this was also an opportunities for bank to take up big projects to provide huge financing and to earn similar higher interest rate from that. To provide huge loan requirements for these infra projects, banks started the concept of corporate funding, like consortium finance, loan syndication, which involved multiple banks coming together to advance the credit loan. Because the loan requirement was huge, so bank came up with the concept of corporate funding, and they started consortium finance, loan syndication, where multiple banks, not only a single bank, there would be a lead bank and multiple banks will be joining together and providing the fund, the loan requirement to the infrastructure building company. As per RBI guidelines, the amount of loan sanctioned should be within overall ceiling of prudential exposure as prescribed for infrastructure financing. So infrastructure also come in priority sector lending. This is one of those sectors which is quite related to the development of any economy. And we read about priority sector lending in previous videos, where we saw that RBI has mandated a particular amount of loan to be given to priority sectors like education, health sector, similarly energy, power, infrastructure. All these are priority sectors where loans should be facilitated. So RBI decided that how much loan can be given to these sectors by the banks. RBI also mentioned that banks and financial institutions should have the requisite expertise for credit evaluation of infra projects. Now, a very high level of expertise was required in this particular sector because it involved very higher risk, since the amount involved was huge and the time period was long. So, infrastructure projects was generally carried for a longer time period. It was usually between 5 to 15 years. It will take one project to get completed if it is a big project. And then the cash flow generation from that will be serving the principal and interest repayment to the bank. So it also involved huge risk that if the project will be delayed, if the project will be stopped for any reason, there was a huge risk, and also the time period involved was quite longer. So the repayment was coming after a longer period, which created an asset liability mismatch in the bank and financial institutions. Now, because of this higher risk, the credit evaluation of these infra projects was to be done very diligently. So, looking at the financial viability, what would be the cash flow generation from a particular project? Will that particular project would be able to repay back to the banks and financial institution? Then looking at the technical feasibility, where this project is going on, what will be the location? Are all the permissions being taken? Then the regulatory authorities, everything involved. So there is a lot of technicality involved when it comes to infrastructure projects. So being aware about all those technicalities and looking at the legal rules and regulations involved. Risk and sensitivity analysis, what is the amount of risk involved in any particular project? Then carrying out the due diligence. So due diligence is totally looking at the credit rating, looking at the loan repayment capacity, then taking all the documentation. All these things comes under due diligence process. So checking on financial viability, technical viability, risk and sensitivity analysis, and due diligence was mandated by RBI to be followed by banks and FIs before providing infrastructure finance to any of the companies. Now, key issues faced by banks in infrastructure financing. It was an opportunity for banks to serve such a huge loan amount, but along with this, it also comes with issues which the banks were facing, because it could lead to higher NPAs if there was any default in the loan repayment. So first issue was long tenure of the loan. No other loans were involving such a long tenure. So most of the infrastructure loans, they were provided by banks, they were long term, ranging between 7 to 15 years. So because the time involved was so long, the risk involved was also on the higher side, and the repayment was coming after a long period of time to the banks and the FIs. Then asset liability mismatch. Most of the bank deposits are short term in nature. So whether we talk about saving account deposit, current account, even the fixed deposits, they are for a limited tenure. And so bank deposits are like asset for any bank or financial institution, because bank deposits are like liability for any banks or financial institution. So they pay the required interest rate to their public for depositing money with them. However, loans are like asset for banks or financial institution, and they charge interest on that. Now, what they have to pay was for a shorter period of time, and what they were getting back as income was being generated after a longer period of time. Thus, there was an asset liability mismatch being created in the whole business scenario. Projection of future cash flows. Loans are provided based on cash flow projection of any infra project. So, infrastructure financing was totally depending on the cash flows projection. So, what all cash flows generation will be possible from one particular project will be requiring the loan amount to be given by banks or financial institution. So, there was huge dependency of repayment on cash flow generation. And because this was an estimation and projection, so it may go wrong. And thus, in this sense also, there was a risk involved. Security for infrastructure loans. Project assets are held as security for loans, but in cases of infra projects like roads, bridges, and dams, the project assets are not to be treated as security for loans. Rights, licenses, and authorizations are treated as collateral or security, but these are intangible assets. So, security is always required, because in case if there will be any default on the loan, how will bank be able to run efficiently? And because interest which the banks charge on any institution, it serves as an income for the banks or financial institution. If that income is lost, it hampers the whole business. And thus security is required, that in case there will be any default, some amount can be recovered by selling of that particular security. But here, in case of infrastructure loans, in most of the cases, the security was the rights, licenses, and authorization provided to these infrastructure building companies. But because of its nature, these were intangible assets, and there's a little insecurity was there in banks and financial institution before providing loans to infrastructure companies. Delay in operation of project. Delay in implementation of the project leads to reschedulement and restructuring of the loan by bank. So many times, because these infrastructure projects required a lot of legalities to be completed, license to be taken, authorizations to be taken, so there is almost delay in multiple projects being conducted by the infrastructure building companies, and thus many times banks and FIs, they do reschedulement and restructuring of the loan by bank. And which also cost some amount and also the time of the banks, and thus these are some of the key issues which is faced by banks in infrastructure financing. So along with this being an opportunity, there was some drawbacks which can be covered by doing proper credit evaluation, by looking at the viability of the project, keeping a follow-up and monitoring over the project, and trying to take appropriate security for these infrastructure loans. So thank you for watching. This was all for this video. Do like and share my video. Subscribe to my channel, DevTech Finance. Thank you all.